All right, so let's do that. Corporate Finance Report, which is item 9. Thanks, Sam, for chairing those last two items. Item 9, Corporate Finance Report. So, Leah and Steve, thank you very much indeed for waiting. Let's do this and then we'll break for morning tea. So over to you.
So we're standing between you and a coffee. Awesome. A couple of things I just wanted to state on this. You'll note that traditionally we've done this corporate finance report, which covers our treasury and our debtors, and then we normally do a finance report every quarter. What we're proposing to do going forward is that we'll have one report, and we'll present monthly. Given the level of debt going forward, I think it's prudent for this committee to actually see an updated report every month, and also it will maybe a bit different. In regards to the Treasury, I've got Steve here with me as well. Obviously, this is the report from the end of September. Now, if I want to go, if you can scroll down for me, please. Keep going to the graph. I want the debt graph, which is on page. I'm just desperately trying to keep going down.
Beginning of page 100.
Yeah, I need that one. Who's controlling that one? Keep going down, please.
Page 100.
We've got it on the hub there. There's the graph on page
100.
100 that you're referring to, isn't it?
This is the maturity
Correct.
profile?
The maturity profile. So the only reason I want to bring this up is because this obviously, the orange, or the yellow, I hate these colours, it refers the new debt. And it's one of those things that I just want to make sure that we're going to keep repeating. We have got approximately 1.5 billion of debt over that term of the LTP, of new debt that we're taking on. And as you'll be aware from the conversations we've had recently about the increase in interest rates, this will have an impact from our financial point of view. This obviously graph that you're seeing has changed based on the early considerations that we are looking at from the annual plan. So it will get updated, especially in the next couple of years of the timing of the CapEx program. The other thing I just thought we'd take the opportunity to do with Steve here is just to give you, obviously everyone will be aware the OCR changed yesterday, so I just thought it might be appropriate for him to give you a couple of comments about that.
Yeah, I didn't really prepare anything, so I was just, if you've got any questions, that's great. But I think the message is that long term, there's no way to avoid interest rate movements. All you can do is try and fix yourself for a little while so it smooths the volatility. What's happened over the course of this year is that because the economy has recovered around the whole developed world, recovered so much more robustly than anyone anticipated previously, what had been an extraordinary reduction in market interest rates that most commentators had thought would go on for a number of years has had to be reversed very quickly. If you like, the long-term neutral hasn't actually changed that much. So, looking out for our interest rate projections in year 7, 8, 9, 10, it's really no different to what it was this time last year. What's changed is how quickly we get from where we were to where we are. This time last year, we were looking at potential for negative interest rates, which was just extraordinary and not unprecedented. German interest rates have been negative for best part of 10 years since the global financial crisis. Japanese has been longer than that. It's not impossible. And at that point, it was really kind of imprudent to fix in a lot more stuff. So we do have some exposure, inevitably, to some floating rates. Plus, whenever we're borrowing new debt, there's only a limit of how much of that you can fix in advance for two reasons. Firstly, because it's imprudent if you end up fixing it all in advance, but then it gets delayed, it gets costly to adjust it. But secondly, by doing stuff in advance, there's a natural kind of premium you need to pay for fixing things in advance. Best example I can think of is before yesterday's official cash rate, I was trying to do a little bit of forward hedging, just out of 2 or 3 years forward, and the interest rate was above 3%. And you're thinking, well, that's higher than what I think it's likely to be by the time we get there. So it's a bit of a moving beast. What we're going to find, the pressure for this LTP is that because the world has changed quite suddenly, we're moving back towards neutral much faster than anticipated. Then there'll be initial pressures in the first 2 or 3 years. Long-term picture hasn't changed, but inevitably there's going to be that kind of volatility. Challenge for us is thinking, well, how do we smooth that without making it too expensive? And can we change internally, how mechanistically the rates budget changes to the interest cost budget? At the moment, obviously, every dollar of extra interest, you need $1 of extra rates to cover it. There's possibly ways we can smooth that a little bit. that raises its own issues that we've got to make sure we're funding enough to repay this debt over the long term. So, you can't fudge it too much because you end up never repaying it. So these are the things we're trying to work through. Short term, it does mean extra pressure on rates for the first few years. Long term, it doesn't change the picture. It's just a question of how we manage that short term.
Just to be clear, fudging it is not a technical term we tend to use in the finance world. But the reason why we're just reiterating this, and it's very clear, and I'm not going to apologise for repeating myself, and you're going to get hear it monthly. We need to be very clear and prudent about our debt levels going forward, and how we manage them, and there will be a huge impact. Okay. So on that note, if there's any questions.
Thank you. Are there any questions? Aaron and then Tim. Aaron.
So just a quick one on the economic recovery, so-called. Governments are just printing money and pouring it into their economy, so that's not really a recovery when you're borrowing $100 million a day, is it, or is it?
I think it's worth separating the issues. The printing money thing is more of a liquidity in the banking system. The only reason that could be inflationary is if that encourages banks to lend more money in an inflationary way. Obviously, one point of it is to make sure they carry on doing business as normal. And that's actually what's happened. Banks are already tightening up on their lending arrangements, so they haven't been profligate in that sense. What we're seeing, though, and it's quite different to most of my working life, is the power of fiscal policy. Governments have been spending a lot of money on supporting businesses, at the same time increasing benefit rates and things like that. We haven't seen this level of fiscal expansion for really a very long time. And what we're discovering is that it's very powerful. When governments support businesses in particular in the way that has been done.
But if you have to borrow to do that, then it's not real. So because you can only borrow for so long, and especially when the interest rate goes up, I mean, the flick at the end of that tail can be quite...
Yeah, it gets a little philosophical there about the role of government. I think for New Zealand in particular, the level of debt that we're looking at, even at its peak, is still pretty conservative. It's lower than it was when it was causing a problem in the 80s. It's lower by far than most of our peers in the developed world. And we're still looking at interest rates, despite the fact they're going back up quickly. They're going back up quickly to sort of 2.5%. So it's not the disaster scenario that some people are painting, and it's still quite prudent. I'm actually quite impressed the way the government has managed, not just the local government, but around the world, monetary authorities have managed.
So you still call it a recovery?
Oh, there's no doubt. Unemployment is very, very low, lower than it was before. Consumer spending is booming. We're having all the supply constraints. Obviously, there's quite a complicated story. But yeah, there's sectors that are really suffering.
Oh, cool.
And that's the nature of change. Some sectors boom and other sectors wilt. But overall, we're booming, probably too much.
Thank you. Tim.
Yeah. So our debt at our repayment on our interest rates are between 88 million and 120 million per annum. Is that correct?
More or less 90 to 100. Yeah.
So it would be really good, I think, for us to have a discussion as a council to look at our debt level and, working with you guys, look at a plan to start reducing it. Because I do think,
Yeah, it's a good point. It's already built into the system to some extent. There's an automatic mechanism where every time we borrow money, we increase rates by, I think it's 3%, in order to make sure we repay that principal over the 30-year period. So the impact of borrowing an extra 100 million isn't just the interest costs, it's the principal repayment as well. So it's like a double whammy. And that's what I was referring to before, that we could maybe adjust that a little bit to smooth out the direct impact of borrowing, but we can't get rid of it altogether because we do need to keep repaying.
The only other difference to that was the COVID borrowing that was taken out over 5 years, not the usual. So we had some extra, which is why we've specifically, with our surpluses, we've actually repaid that earlier.
but if we had the same debt as ECAN, which I believe they're in debt to about 6 million, we would have so much more that lost interest, if you like, that payment on interest to put back into projects or to pay off our debt. So
yeah, I mean,
I know it's a balance, but I think it's one that we've got to have a serious discussion as a council.
it's always a balance for all councils, in the sense that, I mean, the reason why there is $1.6 billion worth of debt in the LTP is because we need to deliver infrastructure, right? So and also given the last 10 years, so it is a balance. So you can't just say, oh, we're not going to borrow. Well, you can, but you don't deliver capital programs. All we're saying is we we need to be make sure very clear when we're looking at this in every decision we make, whether it's OPEX or CAPEX, of we are borrowing debt to do it. So to balance the interest rate raises, the rates increases.
Well, I'm not proposing to stop that, but we really do need a good understanding of where we are and what the risks are with regards to interest rates. And you just have to look back at the global financial crisis. A whole lot of people bet against
Hence why we're saying we will be here every month.
I know that Venezuela Tahi, we're still holding a debt from way back with the AMI Stadium, which is at a huge interest rate, which was locked in then, which was thought to be a good idea.
Yeah. So, I mean, the being made aware of, keeping our governance eyes across, being informed of any developing risks, that's exactly why this report's going to be coming monthly.
Happy to do that.
All right, thank you. Phil?
Yeah, thanks, Leah. Last time the OCR went up by 0.25%, I think you came and said it's going to cost us $5.5 million more in just interest because of that. Have I got that right? Say 5 mil, round it up, down.
5 million, but not just because of the 0.25, because it depends on what our debt is. But
So if it's just gone up 0.25 yesterday, that means it's another 5 mil.
The 5.5 was over the year, so it's based taking into account. So that was the annual plan, right?
Yes.
So on FY23, so that was taking into account what our forecast debt was in new debt, and where we think the OCR is going based on forecast interest rates. So it's not just going up 0.25 means 5.5 million. It was taking about where we think in that financial year 23 based on our forecast, which will take into account predictions on where the OCR will go. But it's not, you can't compare, it's not like for like what you're suggesting.
No, yeah, thank you.
It's important as well that when we're doing these long-term projections, we need to build in anticipated movements in future interest rates. So it's not going to affect us for the whole LTP period, because to a large extent we're anticipating this increase anyway. It's just happened faster than expected.
And anticipating when we're going to borrow the debt.
Yeah.
So the timing of the capital program is absolutely fundamental to this.
Yep. All of these are good conversations to be having and good things for us to be thinking about. No question about it. Any further questions? Sam?
Only just one. It's more just to obviously everyone's benefit. You're looking also at reducing our working capital as well, aren't you, to minimise that
Correct.
sort of short-term borrowing that we need.
Correct.
Yeah.
So that's one
And
of
that
the
will
things
have an
we're
additional
using.
saving to people as well.
Correct. Yeah. So it's using, because we've already pre-funded some debt repayments this year.
Yeah.
But we are carrying quite a high level of working capital, which we will reduce to prudent levels. So to actually minimise that impact of the increase.
Perfect. No, that's great. I'll look forward to seeing this each month.
I should point out as well,
thank you.
that because of who we are, just to clarify, because of who we are, that holding big working capital like that doesn't actually cost us an enormous amount. There is an efficiency reason for scaling it down, but there's also operational tidiness. It's just a lot cleaner to make decisions when you're managing things a little tighter. So we won't say huge cost savings, unfortunately, but we will see a safer management.
But am I right in thinking, though, that given, like you've said, the long-term projection of interest rates, we kind of knew where they were, well, as we could, but it's that short-term
The first
where we're
couple
being basically dealt to because of that OCR increase.
Yeah, quite right.
Yeah. So as much as that long-term might not save us as much, it may help us in the short-term.
A little bit, yeah.
Yeah. Okay.
All right, thank you very much. Any further questions? Okay, so Jimmy. Oh, you're happy to move? Yeah. All right, so Jimmy's moving, Aaron's seconding. Is there any debate? All those in favour say aye. Against? That's carried. Thank you very much. Thank you. So now let's adjourn for a morning tea break and come back at 11:30. We've got 2 more open agenda items to do and then the public excluded. So let's come back at 11:30.